All right, welcome to another deep dive. Today we're taking a look at dividend stocks, those companies that pay you just for owning them. Specifically, we've got an article here making the case for two companies in particular, Chevron and Vici Properties, saying they're primed for a big November. So let's dive in and see what makes these companies so attractive to dividend investors.
You know, both of these companies offer something a little different when it comes to dividends. I think that's what makes this one so interesting.
Okay, so let's start with Chevron. This energy giant. They've got a reputation as, and I'm quoting our article here, well-oiled dividend-paying machine. Over 35 years, they've increased their dividend every single year. That's got to be good for dividend investors, right?
Yeah. Oh, for sure. It really shows their commitment to those shareholders. But I think what's even more impressive is how much they've been growing that dividend lately. Like over the past 5 years, their dividend's been growing faster than everyone else in the energy sector and even faster than the S&P 500. So, I mean, they're not just maintaining it, they're really pushing to grow it, even more than people expect.
Yeah, and on top of that, Chevron's current dividend yield is over 4%. Which is way higher than what you get from the S&P 500. I think that's under 1.5% right now. So for anyone looking for that passive income, Chevron is looking pretty good.
Yeah, but a high yield's only part of the story, right? You got to look at whether that dividend's going to last. And that's where Chevron's future growth projections come in. They're predicting their free cash flow to grow by more than 10% every year through 2027. I mean, think about that. Free cash flow is what's left over after they've paid all their bills and invested in the business. It's the money they can use for dividends, buybacks, paying down debt, growing that by 10% every year. That's a really strong sign. They're in a good position to keep rewarding shareholders.
And what I think is really interesting is that those projections, they're based on oil being just $60 a barrel. I mean, we've seen oil prices go all over the place lately, so that seems pretty conservative. Like they're not banking on some crazy oil boom.
Right, exactly. They're being realistic. And they're still confident they can generate a lot of cash.
Yeah, that's a sign of stability. And that's what you want for dividends, right? You want that confidence they can keep paying out, no matter what happens.
Definitely. And speaking of stability, the article actually calls their balance sheet fortress-like, which means they can handle those buybacks, even if oil drops to like $50.
Yeah, buybacks, that's another way they can return value to shareholders, right?
Yeah.
They buy back their own shares, fewer shares out there. Each share is worth more.
Exactly. And with a strong balance sheet like Chevron's, they've got the flexibility to do that even when times are tough.
But, okay, there's one more thing we need to talk about. Chevron is thinking about buying Hess Corporation. That could be massive.
Yeah, that's a big deal. I'm sure a lot of people are wondering how that fits in. But if you look at the article, they're saying that if the deal happens and oil goes to $70 a barrel, Chevron's free cash flow could double by 2027. We're not even talking about maintaining their growth. We're talking about doubling it.
Wow, and they could even extend their production growth, like way out into the 2030s. I mean, that acquisition could be huge for their growth, and that means potentially even more dividend increases down the road.
Absolutely. It's a potential game changer. They've already got the dividend history, the strong financials, and now this potential to grow even faster. It's a pretty compelling case for dividend investors.
Yeah, all right, but let's switch gears now and talk about our second dividend superstar, Vici Properties.
So Vici, they're a REITs, a real estate investment trust. Basically, they own and manage properties that make money. But what makes them interesting is their focus on experiential properties.
Right, so they own things like casinos, which, aren't really affected by online trends the same way as something like, traditional retail.
Exactly. People still want those in-person experiences, like going to a casino, seeing a show. Vici's tapping into that.
And they've got a solid dividend history, too. 7 years in a row, they've increased their dividend, and their most recent increase was 4.2%, which is actually a top growth rate compared to other REITs.
It is, yeah. And on top of that, their dividend yield is currently over 5%.
5%? That's a pretty significant income stream, especially with how things are economically right now. A lot of investors are looking for that stable income.
Right, and Vici's not just sitting back. They're actively looking for ways to grow their business and increase their income, which means more potential for dividend increases in the future.
And they've got a lot of ways to do that, right?
Yeah, a lot of ways.
Their rental increases. They're tying more and more of their rent to inflation.
Yeah, that's a smart move with inflation like it is. It helps protect their income.
So in 2024, 40% of their rent will be linked to inflation. And by 2035, it jumps to 90%. So no matter what happens with prices, they're in a good position.
Yeah, and on top of that, they're making some strategic acquisitions. Last year, they bought 38 bowling entertainment centers for $432.9 million. And they also picked up Chelsea Piers in New York City for $342.9 million. That's a great way to diversify their portfolio and bring in even more rental income.
And those are smart acquisitions, too. Bowling alleys, entertainment complexes, those are experiences people want, even when the economy's not doing so great.
Right. It's a good way to position themselves for consistent growth.
Okay, and then there's their Partner Property Growth Fund. They're partnering up to improve existing properties, like that $700 million commitment for the Venetian Resort in Vegas.
Yeah, win-win, right. They get to invest in great properties, and their partners get the money they need to make those properties even better.
Okay, and then finally there's their credit investments. So they're lending money to support new developments, with the option to buy the property later, like that $105 million loan for the new Margaritaville Resort.
Exactly. They get the interest income from the loan, plus the option to buy the resort later. It's a really smart approach.
So they've got a lot going on. They're not just sitting back. They're really driving their growth.
Yeah, it's impressive. All these different ways they're working to expand and increase their income, which of course means more potential for dividend growth.
All right, so we've covered a lot of ground here. Chevron with their long history of dividend growth and the potential boost from that Hess acquisition. And Vici with their focus on those experiential properties and all those different ways they're driving their growth. Two very different companies, but both with a lot to offer dividend investors. Now, this is just the start of our deep dive. In part 2, we're going to get into the nitty-gritty and look at some of the financial metrics that can really help us understand their investment potential. So stay tuned. All right, welcome back to the deep dive. In part 1, we talked about Chevron and Vici Properties. Their dividend histories, how they plan to grow. But now, let's get into the numbers. Look under the hood and see what's really going on.
Yeah, it's easy to get excited about dividends, but you always got to check those financials, make sure everything's solid.
So let's start with the big one for dividend investors, the payout ratio. So that tells you how much of a company's earnings they're paying out as dividends.
Right, so if it's really high, it could be a sign they're stretching to keep up with those payments, but if it's low, maybe there's room to grow that dividend.
Exactly. So what are we looking at with Chevron and Vici?
Well, based on their recent earnings, Chevron's payout ratio is around 60%. Vici's is closer to 80%.
80%? That seems a little high.
Yeah, if you compare it to other industries, it might seem like a red flag. But you got to remember, Vici's a REIT. And REITs are actually required to pay out most of their income to shareholders.
Oh, right. It's part of how they're structured.
Exactly. So 80% might seem high, but for a REIT, it's pretty normal.
Okay, so it's not necessarily a bad thing, but something to keep an eye on.
Yeah, always good to make sure their cash flow is strong enough to support that payout.
All right, so what about another key metric, the debt-to-equity ratio? What does that tell us?
So that basically measures how much debt a company has compared to how much equity they have. It gives you an idea of their financial leverage.
So a higher debt-to-equity ratio means they're using more borrowed money, right?
Right, and that can be riskier, especially if things go south.
So the lower the better?
Generally, yeah.
Okay, so how do Chevron and Vici compare?
Well, Chevron's debt-to-equity ratio is super low, around 0.2. Vici's is higher, closer to 1.2.
Wow, that's a big difference.
It is. Chevron's low ratio shows they're in a really strong position. They don't need to rely on borrowing as much, so they've got more flexibility to invest in growth, handle tough times, and of course, keep paying those dividends.
And Vici's higher ratio, is that a problem?
Not necessarily. Remember, REITs often use debt to buy properties as long as they can manage that debt. And their cash flow's good. It's not a huge concern.
Okay, so it's all about context, right? You can't just look at one number.
Right, you got to see the whole picture.
All right, so while we're talking about financial health, what about return on equity? ROE.
Oh, yeah. ROE is important. It shows how well a company is using its money to make more money.
So higher ROE is better?
Generally, yeah. It means they're more profitable and efficient.
Okay, so what are we seeing with Chevron and Vici?
Chevron's ROE is around 18%. Vici's is closer to 6%.
Another big difference.
Yeah, Chevron's high RE, it probably comes from a few things. They run a tight ship, they can charge higher prices, and they're really good at investing their money wisely.
Okay, so that's good for people who want those higher returns. But what about Vici? Does that lower ROE mean it's a bad investment?
No, not at all. Again, it's about context. REITs usually have lower ROEs. because their business model relies on real estate, and real estate doesn't always generate the highest returns.
Okay, so it's not necessarily a sign of weakness.
Right, more a reflection of how they operate.
But we can't just look at numbers, right? We got to think about the bigger picture, like the economy.
Definitely. Things like rising interest rates can have a big impact.
Right, because that makes borrowing more expensive.
Exactly. So for Chevron, higher rates could make it harder to finance their operations.
But they do have that strong balance sheet, right?
Yeah, that fortress we talked about.
Yeah.
That gives them some protection.
And what about Vici? How would they be affected?
Well, they're in a different spot. People still want to go to casinos and shows, even when the economy's not great.
Right, so their income might be more stable.
Exactly.
So even though they're both in different sectors,
Yeah.
the same economic factors
Yeah.
can affect them differently.
Yeah, it's all about understanding their business model.
And how it fits into the bigger picture.
Right.
Okay, so we talked about payout ratios, debt to equity, return on equity, interest rates. We're really getting a good sense of these companies.
Yeah, we're starting to see the full picture.
But there's more to it than just numbers.
Right.
Yeah.
Oh, yeah, absolutely. There are other things to consider, like the management team, the competition, regulations.
Right, the qualitative stuff.
Exactly.
So in part 3, we're going to dig into those factors and see what else we can learn. All right, welcome back to the deep dive. We've spent the last 2 parts really getting to know Chevron and Vici Properties. We look at their dividends, their growth plans, even their financials. So now it's time to step back, look at the big picture and see what it all means for us as investors.
Yeah, we've gone through the numbers. But now we got to figure out how to actually use this information.
Right, because at the end of the day, it's about building a portfolio that works for you, your goals, your risk tolerance.
Exactly.
So let's try to sum up what we've learned.
Okay, so with Chevron, I think what really stands out is that dividend history. 35 years of increases, that's amazing. It shows they're really committed to those dividends.
Yeah, they've been through a lot. And those dividends have kept going up.
Like a well-oiled machine.
Exactly. And their future looks good, too. All that free cash flow growth they're projecting.
Yeah, over 10% year through 2027, even if oil doesn't go crazy.
It means they've got plenty of room to keep raising those dividends. And then there's that potential Hess deal.
Oh, yeah, that could be huge. Could really supercharge their growth.
Exactly. So, when you look at other energy companies.
Not many can match Chevron on financial strength and growth potential.
All right, so now let's talk about Vici Properties. We're focused on those experiential properties. It's really interesting.
Yeah, in a world that's moving more and more online, they're betting on those in-person experiences.
Casinos, entertainment, things like that.
Exactly. People still want to go out and have fun.
And Vici's ready to give them that.
And their dividend history is not too shabby either.
7 years of increases, a recent bump of 4.2%, and a yield over 5%.
Yeah. Those are some good numbers.
And they're not just sitting back. They've got all those growth initiatives.
Rental increases tied to inflation, acquisitions, partnerships, even those credit investments that could lead to more acquisitions.
Yeah, they're really firing on all cylinders.
They're not content with just maintaining things. They want to grow.
So we've got 2 very different companies here. Chevron, the established giant.
With that rock-solid dividend history.
And Vici, the up-and-comer.
Focused on a growing sector.
So the question is,
which one's right for you?
Are you looking for that steady, reliable income from Chevron? Or are you more interested in Vici's potential for higher growth?
It really depends on your goals, your risk tolerance.
We've given you the information. Now it's up to you to decide.
And remember, don't put all your eggs in one basket. Diversification is key.
Exactly. Build a portfolio that's balanced and aligns with your overall goals.
We hope this deep dive has been helpful, giving you some things to think about.
It's just the beginning, though. There's always more to learn.
Keep digging, keep researching.
And keep growing those dividends.
Investing is a journey.
So enjoy the ride.
And invest wisely.
That's all for our deep dive into Chevron and Vici Properties. We hope you enjoyed it, and we'll see you next time for another deep dive.